Hello everyone, this is Sam Tanning with Fidelis Wealth Advisors. We hope you're healthy and finding the support you need in this current environment. We wanted to share some thoughts about the CARES Act, which was passed by Congress and became law just over a week ago. This act has some good news for anyone who has lost their job or may in the coming days. We feel the details of this act may provide some comfort during uncomfortable times. That's why we want to share this brief summary. Before I get into the details, I want to share this slide. Warren Buffett was once quoted saying, "It's only when the tide goes out that you learn who's been swimming naked." You know, in these unprecedented times, we can all feel at least a little financially naked or unprepared. Although it's too late to start preparing for this crisis, there are things we can do to minimize its impact and prepare for the future. Our natural tendencies may be to ignore or avoid our finances. I hope we can take courage and do what we don't want to do at this time. I hope we can focus on things that really matter and that we have control over. As we do, I know we'll find more peace. Okay, I'm done preaching. We will focus on the key points of the CARES Act and how they may impact us. First, we will discuss the rebate checks coming in the next few weeks. Then we'll talk about the backstops Congress has provided to access our retirement funds if we've been impacted adversely by the virus. Next, we'll talk about some short-term changes to student loans, charitable contributions, and required minimum distributions. Then finally, we'll share some planning ideas. Please note this presentation is not meant to be a full summary of the CARES Act or all of its implications or a complete list of tax planning ideas that may be available as a result of the Act. We wanted to send out a quick summary of the main parts we felt impacted most of our clients as soon as possible. So please excuse any shortcomings of this video. In the coming days, the government will be sending the majority of individuals and families a rebate check to help with the current economic crisis. These checks are tax-free income that are based on your income, whether or not you're married, and the number of children you have under the age of 17. Those who are married and their adjusted gross incomes were under $150,000 will receive the full amount of $2,400 plus $500 per child under the age of 17. If you're single and your adjusted gross income is $75,000 or under, you'll receive a check at $1,200 plus $500 for any children you claim on your taxes under the age of 17. These payments will also be reduced by $50 for every $1,000 you make over the limits I mentioned. Also, it's important to make a distinction. The calculation of these benefits are based on your 2019 tax return. If you have not completed your 2019 return, which by the way, the deadline is now July 15th rather than April 15th. If you made over the income limit mentioned earlier in 2018, but your income was lower than the limit in 2019, you may want to quickly complete your 2019 taxes. There's no guarantee that they will look at the tax return as it may be too late. However, it's worth a shot, so file it if your income was down in 2019. Lastly, if your income is dramatically reduced this year and you do not receive a check because you made too much or you receive a reduced check, the IRS will do what they call a true-up on your existing cash flow. It's nice to know you aren't losing the free money most other Americans are receiving. On a planning note, if you do not need the rebate check and you qualify for an IRA or a Roth IRA contribution, you may want to consider using some of this money to contribute. You have until July 15th now to make IRA or Roth IRA contributions for 2019. Another major change that many may not know about, and we hopefully don't need to take advantage of this, but it's related to having access to your retirement accounts if you're experiencing a hardship as a result of the COVID-19 coronavirus. If you can avoid withdrawing from your retirement accounts, especially considering the long-term impact of taking distributions, when your account's values are down, that would be best. It's also nice to know that Congress has provided a backstop if you need it. So here's the new provision of the Act. You can access your IRAs or employer retirement accounts prior to age 59 and a half up to $100,000 in the year 2020. You avoid the 10% early distribution penalty, and you can spread out the income tax liability over 3 years. One other nice provision is that you can even pay back this distribution over a 3-year period. You must meet certain coronavirus-related criteria to take this type of distribution, in addition to either being diagnosed with the virus or having a family member diagnosed. The biggest provision is that if you have experienced financial consequences as a result of being quarantined or the like, you can see the slide for the other qualifiers. It seems that many, if not most, Americans will qualify for this type of distribution if they need it. However, please make sure you qualify based on the criteria before you take a distribution. One last thing on this rule only applies to distributions taken in 2020. So this option goes away on December 31st of this year. Similar to the distribution rule, Congress in the Act has made an adjustment to loans taken out of employer-sponsored retirement plans. The maximum loan has been increased from $50,000 to $100,000. You can take a loan up to 100% of your vested balance instead of being limited to 50%, and loan repayments may be delayed for up to a year. These rules are not blanket changes. They only apply to those impacted by the virus, just as the distribution rules. The next provision relates to student loans. Whether you've been financially impacted by the virus or not, existing loan payments are suspended until September 30th of 2020. If you have an automatic payment set up with your loan provider, you will still need to contact them to suspend those payments. Another nice provision, if you are in an existing loan forgiveness program, the months of suspended payments still count towards your loan forgiveness program. Employers are also being offered some incentives for helping with student loans. We won't get into that here. It's just something to be aware of. It seems in the CARES Act, one of the incentives was geared towards encouraging charitable contributions. The Act created a new $300 above-the-line charitable deduction. These contributions must be made in cash and not given to a donor-advised fund. As most Americans take the standard deduction, this provision allows a small deduction for charitable contributions for many. As an encouragement to donate funds this year, the Act also removes the cap on charitable deductions for 2020 for those that itemize. Another nice provision of the Act is that you are not required to take your required minimum distributions in 2020. Required minimum distributions, or RMDs, are typically required for qualified accounts, such as IRAs and 401ks, for those who are over the age of 72. It was recently changed from 70 and a half to 72. This also applies for non-spouse beneficiaries who inherit qualified accounts. They do not have to take their RMD this year. This is helpful if you don't need the income and would like to avoid paying the tax on the RMD. Those who have already taken their required minimum distribution this year, if you've taken it in the past 60 days, you can return it if you'd prefer not to take the income or pay the tax on the income. If you have received your RMD more than 60 days ago, as we've had some of our clients take theirs on January 15th, we are awaiting further details from the IRS and our custodians, Fidelis and Schwab, regarding this process. Just for reference, this provision was in place in 2009, and the IRS allowed for the return of RMDs after the 60-day period, so stay tuned. A few interesting planning ideas to consider are Roth conversions. Some of the reasons to consider Roth conversion include if your taxable income in 2020 will be lower Now could be a good time to convert while in a lower tax bracket. In our opinion, if you convert while keeping your income in the 10 to 12% tax bracket, it's definitely worth considering. Another factor is your investment account value. If you convert while existing accounts are down and then the investments return and hopefully rebound, it would be best if that was in a tax preferred Roth account. If you are not taking your RMD because you don't need the money and you are okay with paying the tax on a Roth conversion, you may want to consider converting the amount you would have taken as your RMD to a Roth. Based on all government spending and printing of money, tax rates are likely to increase in the future. That's our opinion. Every situation is different and unique, so I'll leave the conversion idea there, and you can discuss it with us or with your CPA. This last slide is a summary of the CARES Act provided by Michael Kitces, one of the better financial planning resources out there. I haven't discussed the major temporary relief and changes to unemployment or some of the Small Business Administration's Paycheck Protection Program with forgivable loans. Just know that this act and the $2.2 trillion are aimed at helping with the current health and financial crisis, and there's a lot of things in there to help people. Thank you for watching this video. We hope you find it helpful. Please feel free to share it with friends and coworkers. At Fidelis, we strive to give agenda-free advice, and we want to be a resource, especially during these interesting times. We have hope and faith that we will overcome these challenging times. We will thrive as people, community, and country as we focus on what really matters and what we can't control. God bless you.